Welcome to part one of our series on Indian Accounting Standard 23, borrowing costs. At first glance, borrowing costs seem pretty simple, right? You take out a loan, you pay interest, end of story. But there's a whole accounting standard on this, and for a really good reason. So in this explainer, we're going to break down the fundamental what and why behind INDAS 23. So let's start with the question that really gets to the heart of it all. We all learn that when you borrow money, the interest you pay is an expense, isn't it? It's just one of the costs of doing business. And yeah, most of the time, you'd be absolutely right. That interest expense goes straight to your profit and loss account for the year. But what if that loan was absolutely critical to building something huge, something that's going to create value for years and years to come, like a brand new factory or a massive power plant? Well, that's exactly where IND AS 23 steps in. And this brings us to a huge accounting concept: capitalization. It sounds technical, but the idea is simple. Instead of treating a cost like a one-off expense that hits your profits right now, you add it to the value of the asset on your balance sheet. That way, the cost gets recognized slowly over the asset's entire useful life. And that is the core idea behind this whole standard. This standard itself lays it out very clearly. You have to capitalize borrowing costs if, and this is the important part, if they are directly tied to the acquisition, construction, or production of something called a qualifying asset. Now, that term is a big deal, and we're definitely going to circle back to it. Okay, so before we dive any deeper, it's just as important to understand what this standard doesn't cover. Sometimes drawing the line around something is the best way to see it clearly. This table gives us a fantastic snapshot. First, notice that IND AS 23 is all about debt, loans, bonds, that sort of thing. It has nothing to do with equity financing. Why? Because paying dividends to your shareholders isn't a cost of borrowing, it's you sharing your profits. Second, think about assets measured at fair value. It just wouldn't make sense to capitalize borrowing costs here because the market is already telling you what the asset is worth. And finally, for things that are mass-produced, can you imagine trying to track and assign a tiny slice of interest to every single item? It would be a total nightmare. All right, so we know when the rule applies, but what exactly counts as a borrowing cost? As it turns out, it's a bit more than just the interest rate you see on your loan statement. So the standard bundles three main things together. First, you've got the obvious one, your regular interest expense on loans and bonds. No surprise there. Second, it includes the interest on lease liabilities. Now, think about that for a second. If you lease a giant crane specifically to build your new factory, the interest part of those lease payments is a real financing cost for that factory project, isn't it? And third, in some very specific situations, it even includes a piece of the exchange differences from foreign currency loans, essentially treating it as an adjustment to your overall interest cost. So, we've thrown this term around a few times now: qualifying asset. It's the key to this whole thing. So let's finally put a pin in it. What really makes an asset qualifying? And there it is. The most important thing here isn't what the asset is, but how long it takes to get it ready. A qualifying asset is anything that takes a substantial period of time to get ready, either for you to use it or to sell it. And here is the really crucial detail. The standard doesn't say, 12 months or 2 years. It's deliberately flexible. It's actually up to the company's management to use the professional judgment to decide what a substantial period means for the specific asset they're working on. This table makes it all very concrete. On the left, you see the perfect examples of qualifying assets: huge, long-term projects like a manufacturing plant, or even intangible assets like complex software that's still in development. It could even be inventories like fine wine or cheese that need a really long time to mature. And on the right, you've got the non-qualifying stuff, things that are basically ready to go from day one, like financial investments or widgets that just roll off the assembly line. So, if we boil this all down, what's the big idea? What's the point of all this? It's really this. Ind AS 23 is all about making sure that an asset's cost on your balance sheet reflects the true total investment it took to get it up and running. And that investment doesn't just include the physical stuff, but also the cost of the money, the financing that made the whole project happen in the first place. And that leaves us with a really important set of questions. Okay, so we know the what and the where. That's a huge first step. But what about the when? When do you actually start adding these costs to the asset? When do you have to stop? And are there situations where you actually have to hit pause on the whole process? Well, that's exactly what we're going to dive into in the next part of our series.
Now that's done. Before you go, next part. Refer textbook thoroughly and write down some notes. See you in the next part.